Options volume hit its second highest level in 2013, but can it continue to grow in 2014? John Lothian News sat down with Jon Najarian of OptionMONSTER to find out what is pushing volumes and the potential going forward. He says the key drivers for the options industry are weekly options, a strong economic recovery, and a continued demand for more options education.
The two biggest things that are driving volumes for the options, or at least holding them. One, weekly options, because as we get more and more weekly options, it's more turnover because, of course, they're an expiring option. And you're in expiration every single week with the weeklies. They're extremely popular because they let you drill down right to the dates you want. So that if you want an earnings cycle and you don't really care about the 2 weeks after the earnings, you can, in many cases, like in Apple or Cisco or Broadcom, I mean, a number of high flyers, techs, whether you want FDA, for a potential approval of a drug or something like that, all of those things let you drill down to precise event times. And I think that's really driven volumes up. The more they expand that, the more volume we'll see. I think we've had a modest recovery, and I don't mean for the Dow and the S&P, certainly coming up from 666 for the S&P to 1850 is a big move. But I mean the recovery in the economy. If we got the economy on track like the market has been on track, we'd be gangbusters. Instead of doing 14 or 16 million options a day, we'd be looking at 30 and 40 million a day. And that's because I think people would be more comfortable and chasing returns even more than they chased them in a low interest rate environment. They, I think, instinctively knew interest rates were low for a reason because they're trying to get things started. If things get started and are rolling, which we all hope that they do in 2014 in a faster pace than they did previous, and maybe with an election cycle here it will, I think then options will be a tool people scramble for. And so I'm very enthusiastic. The biggest things are the continued competition between 12 now options exchanges, I think, that put pressure on exchanges to keep the margin or the bid-ask spreads relatively tight. Because I think that can be an impediment. When you get products that are only traded on a couple exchanges, they tend to get wider spreads without that competition. Pete and I like to talk to customers and like to sort of teach. It feels good to pass on some information and have somebody get it. Additionally, we know that they're not going to blow themselves up if they know what they're doing. We don't try to fool them with jargon. We do use the jargon because it is what all of us in the industry call it. When you're talking about a butterfly, I could say a three-way spread, but everybody in the business calls it a butterfly. When we break it down for them and show them why things are called what they are, it demystifies it a little. And then just working with them and doing paper trading, because they can put it on, see how it reacts, see how they would react as far as how they manage the position once they put it on without risking any money. Time is money, but they're not losing or making any money by doing a paper trade. Instead, they're sort of reinforcing, they're building that muscle memory. And I think that's really important.